We are from Group 1. We are here to present to you the listed companies' performance comparison report. Our group members are Ikhwan Nasir, Mira, Mohana Priya, Nur Nadia and Yamuna. The first company is Gets Global Berhad, a trading and services company. Its ordinary shares is of 50 cents each, authorized share capital at 200 million, issued and paid up share capital at 126 million shares, valued at RM63 million. KBS Berhad is a Malaysian-based investment holding company which operates in 3 segments: investment holding, express bus services, fabrication of coach bodies, and maintenance services. Its subsidiaries include Consortium Bus Express Semenanjung, Malaysia Sdn Berhad, which is engaged in express bus services, and Super Coach Assembly Plant Sdn Berhad, which assembles and fabricates the bodies of buses and provide related maintenance services. It is listed on Bursa Malaysia under Gets Global Berhad, formerly known as KBES Berhad.
The second company was Cream Packet Berhad. Is principally engaged in the business of investment holding, research and development, marketing and distribution of wireless networking and telecommunication products, networking solution and other high technology products and service. The ordinary share of RM20 cent each. The authorized share capital was 2 billion. Issued share capital was 6.9 billion and the paid up share capital is 1.3 billion. The third company is Malaysian Resources Corporation Berhad. Malaysian Resources Corporation Berhad is a leading urban property developer with a large portfolio of successful integrated commercial and residential developments anchored around transportation hubs. Ordinary shares of Ringgit Malaysia 1 each, authorized share capitals of 5 billion, issued share capitals of 2.1 billion, and paid up share capital of 2.1 billion as well.
Our fourth company is Padini Holding Berhad. It's an investment holding company. The main sales of this company is ladies' shoe and accessory, and the dealer of garment for ladies, children, maternity wear and auxiliary products. The ordinary share for this company is 10 cents each, and authorized share capital is 1 billion. Issued and paid share capital is RM65,100,000.
Our final company for analysis would be FELDA Global Venture Holding Berhad, where it is Malaysia's leading global agribusiness and is the world's largest producer of crude palm oil, with ordinary share of 1 ringgit each, authorized share capital of 4 billion, issued and paid up share capital of 3.6 billion. Formula used to calculate financial ratio in terms of performance would be book value per common share, cash return on asset, vertical analysis, dividend payout ratio, earning per share, gross profit margin, price per earning ratio, profit margin, return on assets, return on equity. Analysis on activity would be asset turnover, average collection period, inventory turnover. In terms of financing, analyze in terms of debit ratio and debit over equity ratio. In terms of liquidity position, we have used acid test ratio, interest coverage and working capital. The results of performance ratio analysis in terms of book value per common share for FGV and MRCB is high due to their nature of business, where they have more fixed or long-term and current assets compared to the other companies. Overall, all companies improved their book value per common share except for FGV, which suffered a slight decrease due to higher increase in liabilities compared to the increase in assets. While performance ratio analysis in terms of cash return on assets for Gets Global, Green Packet and FGV have improved from negative to positive. This is due to the improvement of their net cash flow from operation from negative to positive. These companies will have to continue to improve their net cash flow from operation to improve their cash return on assets. The cash return on assets for MRCB and Padini due to higher increase in asset compared to the increase in net cash flows. These companies will have to improve their net cash flow from operation to improve their cash return on assets.
The next will be vertical analysis. This vertical analysis will be conducted for all 5 companies. The percentage of non-current assets to total assets for all companies decrease except for Green Packet, and this may be due to the higher increase in total assets compared to non-current assets. The higher increase in total assets is contributed by higher increases in current assets compared to non-current assets. The percentage of non-current liabilities to total equity and liabilities decrease for Green Packet, MRCB and Padini. For Gets Global and FGV, their non-current liabilities increase may be due to the increase in deferred tax liabilities and the reduction in reserves. Generally, all equities for the companies improve, and this may be usually due to increase in retained earnings or issuance of new shares. Next will be dividend payout ratio. Dividends were not paid for Gets Global and Green Packets. For Gets Global, it is currently suffering losses, and for Green Packet, they have not declared dividend for the last 5 years. Dividend payout ratio for Padini decreased despite an increase in profits due to the increase in numbers of shareholders. The ratio for MRCB and FGV increased despite a decrease in profits due to the reduction in shareholders. Next, analysis will be earnings per share. Earnings per share for Gets Global, Green Packet and Padini improved due to the increase in their net income. Earnings per share for MRCB decreased due to reduction in net income, while for FGV, the decrease is due to increase in dividend payout despite the reduction in net income.
Now we will talk about gross profit margin for all the 5 companies that we have compared. The gross profit margin for all the companies decreased except for the Gets Global, where their profit margin improved to 11% from negative 4%. The gross profit margin decreased for all the other companies due to higher increase in cost of goods sold compared to increase in sales. Whereas when we compare the price per earning ratio, the PE ratio for the Gets Global and FGV are negative. Although it is possible to get the negative PE ratio, company will report it as non-applicable and they know the company is making loss. So for both Gets Global and FGV, investors tend to lose more for every loss the company makes. The other company improves the PE ratio except for the Padini. The increase is due to the increase in the market value per share, while the decrease for Padini is due to the decrease in the market value per share. Profit margin for MRCB and FGV decreased due to the decrease in their net income. Profit margin for the other companies improved due to the higher increase of their net income compared to the increase in sales. Return of asset for MRCB and FGV decreased due to the decrease in their net income. Return on asset for the other companies improved due to the higher increase of their net income compared to the increase in total assets.
Now we go to the return on equity. Return on equity for MRCB and FGB decreased due to the decrease in their net income. Return on equity for the other companies improved due to higher increase of their net income compared to the increase in equity. For the asset turnover for MRCB, Padini and FGB have improved, and this is mainly due to the higher increase in sales revenue compared to the increase in total assets. For GATS Global, the decrease is due to higher increase in the total assets compared to its sales revenue, while for Green Packet was due to the reduction in sales revenue. Average collection period. The average collection period for all companies improved except for GATS Global, which is mainly due to the increase in accounts receivable. For GATS Global, Green Packet and MRCB have high average collection period of more than 100 days due to its nature of business, where they have a longer receivable days. However, it must be noted that these companies must ensure their receivables are received on time to ensure that they can improve their cash flow and cover their expenses. For the inventory turnover improved for all companies except for Padini, but the reduction for Padini is not significant. The improvement for all companies' inventory turnover is mainly due to increase in sales. However, for Green Packet, it must be noted that despite the reduction in sales, its inventories have been reduced significantly, which lead to the high inventory turnover.
The next is the financing ratio analysis, where we first look at the debt ratio. The debt ratio for GATS Global and MRCB improved where they are financing their total assets with less debt, which means less financial risk. For Green Packet, Padini and FGB, the debt ratio has increased, which means they are using more debt to finance their total assets at the same time assuming more financial risk. The debt ratio varies due to the nature of these businesses. The debt equity ratio will be the next ratio that we'll be looking at, where the ratio for GATS Global, Green Packet and MRCB improve where they are financing their total assets with less debt relative to the shareholders' equity. For Padini and FGB, the debt equity ratio has increased, which means they are using more debt to finance their total assets relative to the shareholders' equity. The debt equity ratio also varies due to the nature of these businesses. Next will be the liquidity and ratio analysis, where we first look at the acid test ratio. For GATS Global and FGB, it is less than 1, so this means that they do not have enough liquid assets to pay back all their liabilities. For all the other companies, the ratio is above 1, so it means that these companies have enough liquid assets to cover their liabilities. However, it must be noted that MRCB and Padini needs to further improve their ratio as it is very close to 1. The next is the interest coverage. So the interest coverage for Green Packet, MRCB and Padini improved while the interest coverage for GATS Global and FGB have reduced. The improvement is contributed by the increase of earnings before interest and tax. However, to see if the company is able to service the interest, we must also look at the cash flow and net income. The last ratio that we'll be looking at will be the working capital. So the working capital for Green Packet and FGB reduced compared to 2015. This is mainly due to the increase in current liabilities. GATS Global, MRCB and Padini improved their working capital position mainly due to an increase in their current assets. So to conclude, what we have compared today, it must be read carefully that the investors must understand and interpret carefully the figures given in the annual report and after doing the ratios, because the nature of business and the goal or motivation for each of these companies are different. Thank you.
Thank you.
Thank you.
Bye.